Hey everyone! In this video, we're going to walk through a comprehensive employment income problem which incorporates many of the specific areas you've studied thus far. The expected learning outcome here is for students to be able to determine income from employment for a taxpayer, including relevant inclusions, allowances, benefits, and deductions. Saddle up, because here we go. What this problem attempts to do is take a number of the subject areas that we've taken a look at and studied already and combine them into one comprehensive problem in which we determine employment income for an individual. Now, I've listed a number of the appropriate reference videos here in this slide, and in addition to that, I went ahead and took the narrative of this video and put it into a PDF document. So if you want to have the entire narrative in front of you or beside you somewhere as you go through this problem and watch the video, then I've got both the narrative, which includes all the information about the taxpayer, as well as the solution laid out in PDF. So that should be in D2L under employment income. I'm going to walk you through example 8 from the chapter 4 worksheet. If you haven't printed it out, you might want to do that, or at least open it up in another window so you can refer back to it. I'm going to briefly walk through the narrative and then address each individual line item separately. So this narrative is about a guy, an employee, Mr. Evan Fable, who moves from Prince George to Victoria in order to start a new job with Cramerica Limited. So he receives a T4 from Cramerica at the end of the year, and that includes $160,000 in gross salary. In addition, Cramerica has made a bunch of deductions from the gross earnings. So we've got some provincial income tax, some registered pension plan contributions, EI, CPP contributions, some donations to the United Way, and $1,000 in professional fees. These are some fairly common deductions that you'd see taken at the source by the employer. As we continue through the narrative, we see that Evan has some moving expenses that were reimbursed by the employer. We see he got a $20,000 bonus in the year, of which some of it was paid out. And we see that he got to use a company car that was provided by his employer. Nice. Evan was also provided with a few additional benefits by Cramerica, including some suits, membership to a tennis club, and some advisory fees for a financial advisor. It looks like Evan was also loaned $60,000 to build a pool by his employer. Pretty nice. And he was required to buy a computer and some supplies for the computer. So we're going to evaluate how each one of these things affects his employment income, if at all. We'll go through this narrative item by item and decide what, if anything, we have to do with each one. Now the first thing here we have is Evan earning $160,000 worth of gross salary. This is definitely employment income, and we'll include it first on our answer. I'm going to use a table to lay out my response here. I'll add any inclusions and subtract any deductions or expenses where allowed. Note that it's extremely important that we include Evan's gross salary here, not the net salary. Gross is the salary before any deductions are taken. Speaking of deductions, Cramerica deducted the following amounts from his gross earnings. Let's start with income tax. This is not a permitted deduction from Evan's net income, so we don't include or deduct it in our answer. It has no effect. All this does is represent amounts that have been remitted to the government on Evan's behalf. It's essentially income tax that he paid throughout the year. What about the registered pension plan contributions? Well, there are two components to this. First, there's $4,000 in contributions that were made directly on Evan's behalf. This is Evan's money. Evan earned this in his gross earnings, and the employer, Cramerica, sent $4,000 of it into a registered pension plan. That is a deduction for Evan. In addition to this, Cramerica also made a matching contribution of $4,000. Is this a benefit? Well, even though Evan certainly is advantaged economically by this, if an employer makes contributions to a registered pension plan, this is not considered a taxable benefit. It's specifically excluded, and it can be received tax-free. Therefore, the effect of this is that Evan may deduct $4,000 from his income. So here we deduct Evan's RPP contributions. We don't include the portion that the employer paid because it's not a taxable benefit. This is a great deal for Evan. Any deduction reduces his income. Now let's consider the EI and CPP contributions that were deducted from Evan's earnings. Are these deductions from his employment income? Well, the answer is no. These payroll taxes are remitted to the government on his behalf, but they don't reduce his employment income. Therefore, they aren't going to affect our answer at all. What about the donations? How's this going to work? Well, Evans decided to donate a portion of his salary to the United Way. The employer remits this to the charity on his behalf, so Evan never actually sees the money. Surely you'd think this is a deduction from his employment income. But actually, it's not. While there is a tax benefit to making a donation, it's actually not deductible from income. We're going to talk about this treatment later on in the course. So this isn't going to affect our overall answer either. Finally, the employer paid Evans professional dues on his behalf to the tune of about $1,000. Be careful here. The employer didn't actually pay the dues. They just took a portion of his salary and paid the dues on his behalf. So Evan actually pays for the dues himself. Because professional dues, and we have to assume these dues are related to Evan's job, are one of the few allowable deductions from income for employees, we're going to deduct this in our overall response. Here you can see we're deducting the $1,000 that Evan paid for his professional dues because, he paid them with his own money effectively. Next, we'll deal with the moving expenses that Kramerica paid Evan. So what's the issue here? Well, it's whether or not the money that he got is a taxable benefit and should be included in his income. The answer is that no. Moving expenses paid on behalf of an employee to move close to their place of employment are not a taxable benefit and they won't affect income. Therefore, we don't do anything with this. This is another great deal for Evan. Let's address that bonus now. This clearly has to be included in income, but how much of it? Well, the answer is that only amounts paid during the current tax year are included in employment income. Any remaining amounts will be included in next year's income. So we add the $15,000 that was paid in the year to his employment income. So here we have a car that's been provided to Evan throughout the year. We have to calculate the taxable benefit, which is going to include a standby charge and an operating cost benefit. I'm going to do this on the following slides. First, we'll calculate the standby charge. Now, given that there are a few ways to calculate the standby charge, we need to ask ourselves a few questions to come up with the right formula. First, does the company own or lease the car? Well, in this case, they own it. So we're going to use the 2% of the cost of the car times the number of months times that the car, is available to the employee. Now, secondly, we're going to evaluate whether we can reduce the standby charge by asking if the car is used more for employment or personal purposes. Now, given that there were a total of 70,000 kilometers driven in the year, and of those the car is driven 10,000 for personal use, we can assume that therefore it's driven more for personal use and the standby reduction is going to apply. We can go ahead and calculate at this point. So our standby charge is going to be calculated as follows. We have the 2% times the cost of the car, including GST, and we have 12 months that the car was available to the employee. We then multiply that by the standby reduction over here. This is done by taking the number of personal kilometers, 10,000, over this prescribed multiplier of 1,667 times the number of months the car was available during the year. In this case, it was 12. When we do all the math here, we come up with an amount for the standby charge of $6,299. Next, we calculate the operating cost benefit. And the operating cost benefit can also be reduced in situations where the company car is used more for employment than personally. Because we have more employment than personal use here, we can apply the operating cost reduction, and we can choose to include the operating cost benefit calculated using the prescribed rate, or we can include the 1/2 the reduced standby charge that we calculated in the previous step. So which one are we going to choose? Well, given that he's going to pay tax on the amount of the inclusion, a smaller inclusion means less tax. So we're going to choose whichever one is the smallest number. So our operating cost benefit here is going to be one of these two things. Our initial operating cost benefit using the prescribed rate times the number of personal kilometers is 0.26 times 10,000 or 2,600 bucks. We can then take a look at the standby charge that was calculated in the previous step, multiply that one by 1/2 and compare the two. Again, we're going to want to choose the smallest one because we want the benefit inclusion to be as small as possible. So in this case, we're going to choose the $2,600. We now determine the total taxable benefit by adding our reduced standby charge to our reduced operating cost benefit. This gives us a total taxable benefit of $8,899. This amount is an employment income inclusion and we'll include it in our running total. Again, this is an inclusion, so it increases Evan's income. This makes sense as he effectively got something for nothing, and he's going to have to pay tax on it. Next up, we'll look at some of the other benefits provided by Cramerica to Evan throughout the year. Should these be included in his income? Firstly, the allowance for suits is definitely included in income. The general rule is that allowances must be included in income, and Evan is essentially given $3,000 to look good here. So we're going to include it in his income. Next, the tennis club membership is likely to benefit Evan more than his employer, so we're going to include that in his income as well. Finally, the $4,000 paid to a financial advisor for Evan is definitely a benefit to him, so it's going to be included in his income. Note that if these were fees for mental or physical health counseling, they wouldn't be included in his income as that's specifically exempt. So we add in the benefits here for the suits, the tennis club, and the counseling. Now we're going to look at the loan Cramerica made to Evan to build a pool. Is there a benefit here? Well, because the loan is provided at rates that are lower than the prescribed rates, we'll have to calculate the benefit and include it in Evan's income. Note that the loan that was provided to Evan is at a rate of 2%, and the prescribed rates for the various quarters are 3, 4, and 4.5 respectively. All right, let's figure out Evan's taxable benefit from the year as it pertains to the loan. Here's the formula that you guys should be familiar with at this point, and we'll just walk through all the numbers. So we'll start with quarter 2. We'll come up with any imputed interest, and we're going to calculate that using the CRA quarterly prescribed rates for the various quarter. Now we'll ignore quarter 1 because the money wasn't loaned until April, so Evan doesn't have to pay any, or he doesn't have to include anything in his income because the loan wasn't outstanding during quarter 1, so there'll be no quarter 1 income inclusion. Quarter 2, however, starts with April 1st, and that's when he borrows the money. So we'll take the principal here of $60,000, the amount that he borrowed from Cramerica, times it by 3%, which is the prescribed rate, times 3 months out of 12 months, April, May, and June, and that'll equal $450. We'll do a similar process for quarters 3 and 4. The principal amount times the prescribed rate for those quarters times 3 months out of 12 months. We get $600 for quarter 3. We get $675 for quarter 4, giving us a total of $1,725. Now we're going to subtract any interest that's actually been paid by Evan during the year. So in order to do this, we'll move over to this second step right here, where we will take the amount of the money that he borrowed, $60,000, times the interest that he actually paid. He was charged 2%, so we'll multiply 60,000 times 2%, and we'll multiply that out by 9 over 12, because he borrowed the money in April. April, May, June, July, August, September, October, November, December. 9 months out of the 12 months in the year, for a total of $900. We'll subtract that. He's not going to include that in his income, because that's not the benefit that he received. The total of the benefit he receives is that imputed interest right here, minus interest he actually was charged right here, for a total taxable benefit of $825. The conclusion here, Evan includes $825 in his employment income, which we'll do in our running total. So here we include the $825 as part of Evan's income. Yep, he's going to pay a little bit of tax, But when you think about it, he got a $60,000 loan to build a pool for next to nothing. It's still pretty awesome. Finally, Kramerica required Evan to purchase a computer and some computer supplies for his job. If he spends his money on capital assets for work, can he deduct this? Or can he amortize it over time? The answer here is that employees are rarely allowed to deduct capital assets, with very, very few exceptions. Things like supplies, as long as his employer required him to buy them and didn't actually reimburse him for the costs, can be deducted, but these deductions are also limited. In this case, we'll be allowed to take the deduction, but the cost of the computer is just something Evan's going to have to eat. And here we're going to deduct from his employment income the supplies that he was forced to pay for and he was never reimbursed for. He'll be able to deduct this from his employment income. We now total his employment income for the year, $187,244. He's going to include this amount in his net income for tax purposes. Now it's worth noting here that you're going to want to provide notes, as I'm circling here, detailing all the calculations that you made or any reasoning behind why you came to the decision that you did. If you just include the totals over here, it's not going to be enough for me to know how you figured them out, especially if you're off by a little bit. So always include some explanation as to how you arrived at a number or how you arrived at a decision to include it or not include it, or deduct it for that matter. For example, here are a couple of the notes that would help the reader, me in this case, understand your decision making and why you included certain amounts. You'd want to make a note every time you have a calculation or there's something that you want to explain. That's it for my walkthrough. Great job, everyone. If you want to try out some similar problems to give yourself some practice with these comprehensive type problems, again, check out the course pack as well as the worksheets provided in D2L. Good luck!